Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1319A, and today's date is June 29th, 2017, and the title of the episode is Central Banks Are Now Colluding with Each Other to Trigger the Collapse. Let's get into the economic collapse financial news. Now, we understand that the real estate market, well, it's imploding on itself. We're seeing the retail apocalypse. This is what everyone is calling it. And we know that Credit Suisse came out and they suggested that nearly 9,000 retail locations could permanently close. And we see figures that are much higher than this. And we know there's going to be a huge amount of bankruptcies. And everything is interconnected because when these retail outlets start to close, we have all this real estate. Another problem is that there are these private label credit card issuers that are connected to these stores. Now, if these stores start to shut down, well, they're going to be in trouble. Now, Moody's is pointing out that there's going to be a problem with the private label credit card issuers, with just 5 companies accounting for nearly 80% of the credit balances outstanding. And as retailers close stores in an effort to improve their profitability, trying to stay alive here, well, what's going to happen is the trend will put upward pressure on private label charge-offs. And some of the companies that are going to be hit very, very hard are Synchrony, Alliance Data, because they rely almost entirely on private label credit cards. And we can see right now that both Alliance Data and Synchrony, they're already starting to show signs of stress. So when this continues on throughout this year and more stores are shutting down, more are going bankrupt, we're going to have a major problem on our hands. And as we can see, with the retail market, with the real estate market, everything is interconnected. And once the dominoes start to fall, well, it's just like a cascading effect, and you won't be able to stop it. Now, we see the BEA, they released their third estimate of the GDP. It was from 0.7% of the first quarter. Then they revised it to 1.2%. Now they're saying, we're going to bring this up to 1.4%. And they're saying because consumer spending, this is what brought it up. And in the past, it was all based on healthcare, Obamacare. But that wasn't where people were spending their money this time. This time, people were spending their funds on recreational vehicles. And actually, they bought a lot of recreational vehicles last year. Now, these recreational vehicles, these are like RVs. So are people selling their houses and getting into RVs so they can be mobile and prepared from when this economy comes down? Or is this the older generation selling off their homes saying, we don't need this type of house anymore. We can live in an RV. It's a lot cheaper and we can move from place to place. But we can see this is the trend. But again, they revise these numbers. They push certain data in different directions to boost the GDP numbers, and we can see they've pushed it up to about 1.4%. And again, what does this really mean? Not much, because it is a manipulated number. But when we look at the hard data all over the place, we can see that it really doesn't make any sense, because when we look in the past, we can see all these GDP numbers, well, it was all based on healthcare, then it was based on soybeans. It's all these one-off things, and it's nothing substantial where the GDP number is consistent over time. I mean, bringing it up to 1.4, 1.7, 0.9, I mean, it seems like they're trying to convince us that this is the new normal right now. And if it is, we're in a lot of trouble. Now, the Federal Reserve announced that all the banks, they passed their stress test for 2017. 34 banks, well, they're good to go, and it looks like they're fine. So what these banks are doing right now, they are going to buy back their own stocks. 3 of the biggest Wall Street banks announced they were earmarking around $47 billion to buy back their own shares of stock. Now, JP Morgan Chase, they led the pack, where they were going to spend around $19.4 billion over the next 12 months to buy their stocks back. And then there was Citigroup. They were projected to buy back around $15.6 billion, Bank of America around $12 billion. Now, the mega banks on Wall Street are engaging in these buyback binges despite a growing chorus of critics who say the practice actually harms the overall economy. Now, back in September of 2014, the Harvard Business Review, William Lazonick, wrote the following. 5 years after the official end of the Great Recession, corporate profits are high and the stock market is booming. Yet, most Americans are not sharing in the recovery, while the top 0.1% of income recipients, which include most of the highest-ranking corporate executives, reap almost all the income gains. Good jobs keep disappearing, and new employment opportunities tend to be insecure and underpaid. Corporate profitability is not translating into widespread economic prosperity. The allocation of corporate profits to stock buybacks deserves much of the blame. Consider the 449 companies in the S&P 500 index that were publicly listed from 2003 through 2012. During that period, these companies used 54% of their earnings, a total of $2.4 trillion, to buy back their own stock, almost all through purchases on the open market. Dividends absorbed an additional 37% of their earnings that left very little for investment in productive capabilities or higher incomes for employees. There is one more serious problem with Wall Street banking buying back their own shares. For reasons no federal regulator has yet to explain, the banks are allowed to operate their own quasi-stock exchanges known as dark pools and trade in their own and other Wall Street bank stocks. And what does this mean? Well, they have the ability to manipulate the market. And this is what they've been doing. And buying back their own stocks, this is not going to help the economy whatsoever. But we know this. The banks are not here to help the economy. The central bank is not here to help the economy. Actually, what they're doing, they're getting prepared for an economic disaster. We see right now, according to the latest CBO calculations, the Treasury will run out of cash in mid-October. They estimate that without an increase in the debt limit, the Treasury, by using all available extraordinary measures, they'll only be able to keep this operational until mid-October. Now, Treasury Secretary Mnuchin is saying that, yes, we need to raise the debt limit. Actually, we should abolish the debt limit and just let us borrow as much as we possibly can. And of course, this is what they want all along. The banks, the central banks, the corporations, the deep state, they want no debt limit whatsoever so they can just continually print or create currency and basically stuff their pockets. This is what they're trying to do. And they've been doing it for a very long time. And it doesn't really matter at this point if there's a debt ceiling or no debt ceiling, because you know Congress, they're in the pockets of all these different entities. They're going to raise the debt ceiling no matter what. So it really doesn't matter if we're approaching a period of time where the Treasury is running out of funds, because we know that the debt ceiling is going to be raised. We know they're going to borrow more. We know we're going to be put into more and more debt. This is a fact. We can't get around this. Now, yesterday, Janet Yellen, she made this statement where we most likely will not see a financial crisis in our lifetime. Now, there's many traders out there, financial pundits, and they're all going off on this statement saying this is absolutely ridiculous. And one FX trader, former FX trader, fund manager Richard Breslow, he's saying he's worried. He's worried about investors' level of delusion in the markets and worried that the central bankers are so convinced of their own omnipotence that they're telling people a complete lie. And this is exactly what they're doing. Actually, Fed Ballard is out there, and he is saying that the market reaction to March tightening has not been good at all, because we would have expected yields to rise with the policy rate. And what we're seeing is that's not happening. And what is happening is it's falling. And this has happened every single time the Fed pushes rates up. We see the opposite occur. Now, the question is, are the central banks intentionally crashing the system? Are they colluding with each other to set off a spark that's going to bring down this economy? Now, let's think about this. Since 2007, the world has packed on a staggering amount of debt. So in 2007, during this debt bubble crisis, there was about $149 trillion worth of global debt. 10 years later, it stands at $217 trillion. Put another way, the world has packed on another $68 trillion in debt since the last debt bubble. Now, in terms of debt to GDP, the world has risen from 276% in 2007 to 327%. Why does this matter? Because this debt was built on the back of low interest rates. In the last 10 years, bond yields have fallen dramatically thanks to the endless central bank intervention. In the U.S. Treasuries, it hit an all-time low. In Europe and Japan, sovereign bond yields actually went to zero or even negative as far out as 10 years. So we have a massive debt bubble based on interest rates remaining at or near record lows. Globally, central banks have sent a clear message. The cost of money, also known as bond yields, is going up. Global central bankers are coalescing around the message that the cost of money is headed higher and markets had better get used to it. Now, just weeks after signaling near zero interest rates were appropriate, Bank of England Governor Mark Carney suggested that the time is nearing for an increase. Janet Yellen said her policy tightening is on track. Canada's Stephen Poloz reiterated he may be considering a rate hike. So right now, the world debt to GDP is around 327%. All of this debt was issued at a time when bond yields were falling. Central bankers now want bond yields to rise. So when we look at this, you can see that what are they trying to do? Are they trying to crash the system? Of course they are. This is exactly what they're trying to do. And if you look back in time, we see the same pattern over and over and over. And this is exactly what they're trying to do. They want the system to come down. The system right now cannot operate without stimulus, without the central banks buying up stocks, without the central banks manipulating the markets. This is not an open, free economy, and the market is not just working on its own. The central banks have been controlling it all along to create this illusion. This is why they have a trading desk. This is why everything's computerized. This is when they click the button, they can make things move up, make them move down. They have full and total control. They have stimulus going everywhere. They're passing QE from one country central bank to another to keep everything operational. But it's not real. That's the problem. It's not where, all these investors and all these individuals are in here and they're making a market and the market's going to react to certain things. No, the central bank is creating it. And if they step away from it, it completely falls apart. And they know this. They knew it for a very long time. This is nothing new. And it's at this point where the real economy, which is not dependent on them whatsoever, is falling apart. Look at retail, look at housing, look at the GDP numbers, look at the corporate debt, look at commercial real estate, look at everything that's going on around here. The one thing they can't stop is the real economy falling apart. This is their major problem. It's always been a problem. They can't make the consumer go out and take their dollars and spend it. I mean, they can try where they can say, okay, we can accept the subprime people in auto loans. We can accept the subprime people in real estate. But for people to go out and spend their money in retail when they're completely tapped out, they can't make it happen. This is the downfall of the central banking system. And again, 70% of consumer spending makes up the economy. And if 70% of the people are holding on to their funds because they don't have enough to go out and spend and they're just keeping whatever they have, the economy falls apart. Retail falls apart. Stores close. There's more real estate. They can't sell homes. No matter how low you bring the requirements for taking out a loan, people still can't do it. This is what we see when a system breaks down. This is what we're seeing right now. Why do you think over time, when we first started out and we looked at retail and we said, well, this is not going to be a good year, and people said, no, because everything's moving to online. Don't worry, stores are going to be fine. Look at it today. Look at from the beginning until now, going back to 2008, how it slowly crept up, and we're at a point where retail stores are going to be closing left and right. Do you think by the end of this year it's going to improve and stores are going to be all open and everyone's going to be open for business and people are going to be spending? No. You're going to see malls that are completely empty. You're going to see strip malls that are completely empty. You're going to see a lot of people who are looking for work. Well, of course, this is going to be hidden because, again, this is what the government has set up. This is what the central bank has set up, where they can hide all the people that are out of work. They can hide all the people that are looking for food because they're on food stamps. The system was developed to hide all of this so you don't catch wind of what's really going on. And it's just going to get worse as we move throughout this year. And I think these retail numbers, I think these are going to be doubled. The bankruptcies, doubled. The amount of retail space out there, going to be doubled. The housing market is just going to implode on itself. This is why the central bank is getting out right now. They're getting prepared. The banks are getting prepared. You need to get prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.